Now in capital rationing, don't forget, this is a scenario where the company doesn't have enough money to invest in all the investable project. Okay, what that means is that as a company, you don't want to invest in all these 10 projects, for example, or all these 4 projects. However, if you have to invest in all of them, okay, the initial amount that that is required, okay, the initial investment cost is more than what you have. Okay, so they're all good projects. They all have positive NPV. Okay, they are all investable. However, you cannot invest in all of them. Why? Because we do have a case where we don't have enough money. In short, okay, we don't have enough money to invest in all those projects. Okay, so you have a scenario where the funds you have are insufficient. Okay, to compare to the total amount that is required by your investable projects. Okay, a capital rationing situation. And you have two situations. You have what we call the hard capital rationing situation, and you have the soft capital rationing situation. Well, the distinction simply, do you have what's the term to use? Or the restrictions or the funds availability. Okay, what is causing this restriction? Okay, what is causing this funds unavailability? Okay, is it because of internal factors? If it is because of internal factors, for example, the management have dictated that, hey, we are not going to invest more than 10 million. Okay, we have the money, but we are going to make restrictions. Okay, if it is imposed internally, then we call it the soft capital rationing situation. Okay, then you have the hard capital rationing situation. Okay, and the hard capital rationing situation, this is a case where the funds restrictions is not because of internal factors. It is imposed by external factors. It is the market that is imposed this restriction. Okay, for example, if you are a bad lender, borrower, okay, in the past, in case you did not pay money, okay, in the future, no one is going to give you money. Okay, it's not because you want to, it's because the market said no, you are a bad borrower. Okay, you're bad data to us. We're not going to lend you money. Okay, so that's because the market is one that causes these factors, is not out of the company own volition. Is the market that is saying we are not going to give you money. Okay, or maybe the market is always depressed. Okay, no one wants to invest money. Okay, if you are to issue shares, okay, maybe currently will not be the best idea, maybe. Okay, because the market is already depressed. Okay, so the market, the restrictions are imposed externally. Anyway, the question here is that how do we invest? Okay, in the case we have cases where we do have capital ratio restriction. Okay, the investment. Okay, first you need to consider are the project divisible or are they indivisible? Okay, the funds you have here, are they divisible or are they indivisible? Okay, if they are divisible, by being divisible, divisible means that it is possible for us as a company to invest in portions. Okay, you can decide this year I'll invest 10%. Next year I invest the balance, the remaining, okay, 90%. For example, in construction, you don't have to finish the entire project today. Okay, it's not a must you have today. Okay, you can decide if we are beginning this contract by the government. Okay, we as X company, okay, we are going to do let's say if we don't have fund this year. Okay, the entire project is going to have 10 kilometers or let's say 100 kilometers. Okay, so we can do in portions. This year, once we invest, we are going to construct 20 kilometers. Next year, let's say 20 kilometers once the funds become available. So it is possible to invest in portions. Okay, decide to construct in portions, for example. Okay, however, there's some you can't do so. Okay, we call the indivisible projects. For example, in case you want to buy a machine, you can't decide to buy 10% of a machine this year, 30% next year. Is not possible. Okay, you have to have all the money upfront. In short, okay, those are the indivisible projects. Okay, so if they are divisible projects, okay, if they are divisible projects, what do? We're going to rank them based on the profitability index method. Okay, we're going to rank them based on the profitability index method. Okay, we rank them based on their PI. Okay, now what's this index? Now this index simply try to rank the project based on how much cash flows in present value terms, okay, do they bring on table for every dollar that the company spent on them. Okay, for every dollar we spent in this project, how much cash flow, okay, in present value terms does it bring back? Okay, I call the PI. Okay, and definitely the higher the PI, the more valuable, okay, the more invaluable, okay, the project will be to the company. Okay, so the higher the PI, the more cash flow does the project generate on behalf of the company or for the company. Okay, I call the use of the PI method. Okay, So you're going therefore to rank them based on the PI. We first, the one that has the highest PI, we invest our money first there, okay? Going down, okay? If by the time the funds are finished, we cannot invest in a project, then we ignore them. We say that, hey, we don't have enough money to invest in. They're good projects, okay? They have good PIs. However, we're going to, since you have a lower PI than others, we're not going to invest in you in quote as a project, okay? Why? Because your PI, your returns, okay, because the return actually, okay, are lower than some other good projects that are above you in quote, okay? Then if maybe the funds, by the time that the funds are getting finished, okay, there's the next project, okay, that we as a company need to choose, okay, it is going to cost us 10 million. However, we only have 3 million remaining. What do? You invest, therefore, in 30% of that project. Do you get it? If the time that once we invest in 100% wholesome projects, okay, and the balance in quote that is remaining out of what is available is 3 million, and this project requires 10 million, we're not going to say you're not going to invest the project. It is divisible. What do? You invest therefore in portion of that last project, which is therefore equal to 3 million out of 10 million. We therefore invest in that percent of the project. Okay. Is that clear? The index, let me show you the formula for the index. The PI, okay, is given us, which is given as present value of cash flows. The value you're going to see from year 0 to infinity, okay, not infinity, until the end of the life of the project. We divide by the initial cost. Okay, that's the PI. Okay, the present value of cash flows you'll be earning between year 1 and the nth year. You divide by the initial investment cost. That will give us therefore the index or the PI. And as I mentioned, don't forget the one that has the highest PI, therefore, is much more valuable than the one that has low PIs. Clear, Brian?
Yes.
Sakina, it's clear?
Yes, sir.
Great. Let's do an example then. Okay, I have an example here, which I don't want to do. Okay, I think you can do it on your own. But I want us to do an example from the examiner. Okay, so let's go therefore through the question bank. Okay, divisible. Yes, yeah, it is. This is OAP company, page 47. OAP company, page 47. I want us to do part B. OAP company, part B. So go through it, we discuss together. OAP company, page 47. We answer part B. Okay, I suppose that you're going through the question. So let's read it together. This is page 47. Here. Okay, I have it with me. So share. Okay, this is OAP company. Okay, so here, so for the first thing, as I mentioned, you first consider, are they divisible? Okay, and this example, you do that the project are divisible, okay, and B and D are mutually exclusive, okay, that means therefore you have to invest either in B or D, but not both of them at the same time, okay. Then you talk for project A, we assume it has a 0 NPV, okay, and E is a must project, okay. I hope you have seen that just before project E is a must to be undertaken. That implies therefore, even before you try to think of A, B, C, and D, the first thing to consider is to take the money and invest in E because it's a mass project. Okay, therefore, let me call this a project. I'll begin with E because E is a must. E, okay, sorry, A, B, sorry, B, C, D. Okay, so this is the what they call it, initial capital, NPV. We call this NPV. NPV for E is 0. Okay, for A, the NPV is equal to NPV 2.1 million. For B, it's 1500, 1550. For C, 1350. That's too big. This is why I normally prefer to have them in thousands. Okay, always have your working in thousands if possible, always, because you can make a mistake, or yeah, you can be able to identify mistake a bit earlier. Okay, before you go ahead. So this is NPV, the initial capital. Okay, can I simply, yeah, let me just have initial capital. So initial capital or initial cost. Initial cost. Okay, for E, you've been told E will cost 5 million. So 5 million. Okay, then A will cost it will cost 2.5 million. Then B will cost 2.2 million. This 2.2, not 22. Then C will cost C will cost 2.6 million. Not 26. Then D will cost 1900. Okay. Don't forget to see the PI is given us the sum of present or cash flow. We divide by initial investment cost. So here PV of cash flow. Okay, just to remind you, the NPV which is given us, NPV is given us PV of cash flow minus initial cost. Now we have the PV. We want to have the NPV. We need to get the PV. The PV of cash flow is NPV. This is a minus becomes a plus the initial cost. Okay, so we get the present value simply NPV plus initial cost. Okay. Therefore, PV of cash flow therefore be equal to the NPV. Okay, I don't need to do that for, okay, and I can do that, but no need for it. It'll be equal to the initial cost, okay, plus the NPV. I don't need that for Z, for E, but I can do so. It's no problem. I do that for in G here from E all the way to D. Give the present value of cash flow. Clear, Daisy?
Yes.
Sorry?
Formula in the present value of cash flow, what did you do?
Let's simply add it because I want to have the NPV. Don't forget NPV is equal to NPV is equal to PV of cash flow minus initial cost, isn't it? Initial cost, IO is IO. So since I have the NPV, I have the initial cost, then I can get the present value simply equal to the NPV plus initial cost, isn't it?
Yes.
Okay, great. So that's the calculation for the present value cash flows. So here I can get the index. Okay, let me copy PI. That's the index. The index, I don't do that for E because E is a must, so you don't need to rank it. Okay, so I begin with A, it will be equal to the PV of cash flow. Okay, divide by the initial investment cost. Is the present value cash flow, we do initial investment cost. That's for A. Then I do the same for B, C, and D. Then here I can rank them. Okay, no need, but let me just rank them. Okay, this therefore is the first position because the mass. Okay, don't need to rank it. Anyway, let me not rank it. So let me rank the others. So A, D has the highest, therefore take D. Then B is the next, but D you can't rank it. So you have, since you've taken D, you can't take B because they're mutually exclusive. You can only take one of them. So you can't take B now because you've taken D. Therefore, we go to the next one, which therefore will be 2. This will be the third. Okay. Therefore, you can't take this one. Can't take. Okay. So leave it at this. Then here I can say.
Sir.
Yes.
Why can't we take B?
Because you're told that B and D are mutually exclusive. So you can only take one of them. So since you're taking D first, then you can take B.
Okay, I get it. Okay.
Okay. Then here is capital allocation. Okay, we allocate the capital. Okay, so for E, we take 5 million. That's the cost. Okay, so don't forget first for the yes.
But we say that E has to be the first one.
Sorry, E. Yeah, E definitely is a must. So you have to invest in E first before even allocate the funds among the other, the A, B, C, D. Yes.
So why didn't we rank it as first?
Because it doesn't require ranking as per se, because it's
Okay.
on its own. As I don't know what the term to use here. It's a must to be taken, so it doesn't require any ranking.
Okay.
But you can take it. There's no problem in case you take one. There's no problem for sure. But okay, there's no problem. But it is a must to invest in E. So it doesn't require any ranking because it's a must project. You get it?
Yes.
Okay. So E take 5 million. Don't forget here the amount available is 10 million. Okay. So you can't invest more than 10 million. 10 million. Put another zero. So you can't take more than 10 million. So here we've taken 5 million to invest in E. Therefore, the balance is going to be shared among B, C, and A. Okay. Therefore, D has the first ranking. Therefore, let's invest first in D. If you take in D, the initial capital was 1.9. So here it is. What's the balance? The balance is equal to the balance available is 5 million plus 1.9 million minus 10 million, which therefore give us 3.1 million. Therefore, go to next to C because the next C is the next position. So C, it consume 2.6 million, and you have 3.1 million. Therefore, it is possible for us to invest in C whole sum. Okay. Then we go to the next one, which is A. In A, it requires 2.5 million, as seen here, but you don't have 2.5 million. Why? Because so far, E, C, and D have consumed 9.5 million. Can you see that? E, C, and D combined wise have already taken 9.5 million. What's the amount available? 1 million. Sorry, 10 million. Therefore, A takes the balance. Okay, we invest there for the balance, which is therefore is 500,000. Okay, the sum is 10 million. Is that clear, Brian?
Yes.
Okay, great. Look at how you're going to be therefore be allocating the 10 million among these competing projects. Okay. The next is the NPV. It was NPV. Don't forget, let me just put this in home. Okay, because this is a portion. The others are 100%. But however, for E, there was nothing, 0. For C, the NPV, already done that. We have it here already. For D, we have it here already. Now, for the case of A, okay, don't forget A, the total initial investment was 2.5 million. For A, the total initial investment was 2.5 million. However, we have only invested 500,000. Therefore, the portion invested in A, okay, is equal to 500,000 divided by the total amount that was required, 2.5 million. Clear? Daisy?
Yeah.
Nafisa is clear?
Yes, sir.
So could you repeat this part, please?
The portion invested in A, the total amount that was required for A was 2.5 million. The amount available is only 500,000. Therefore, the portion we have invested in A is 500,000 minus divided by the total amount that was required, 2.5 million. Clear?
So I don't get why did you divide?
We want to get not the NPV. Okay, I wanted to do that first part. Okay, what is the portion we have invested in A? 500,000 divided by 2.5 million. Is the portion clear?
Yes.
The NPV therefore will be times the NPV we could have received if you had to invest in 100%, which was 1 million. Clear there?
Yes.
Therefore, that's the NPV. Therefore, we will be receiving if you have to invest in into 20%, which should be 20% in A. We get 200,000. Therefore, sum with NPV. Therefore, simply sum. And you get 30, 50. That's what the examiner was asking you. What is the NPV to be received if you have to invest? It's okay if you have to make that investment. Question clear? The maximum NPV you'll be receiving if you have to invest in E, A, C, and D, and you invest 20% in A. question, Nafisa?
So could you please show me the formula for PI?
Clear?
Yes, thank you.
Okay. Okay, and that's how we do the first allocation in case we do have divisible projects. Okay, so in case you have divisible project use, you rank them based on their PI, where PI is simply present value cash flows. We divide by the initial investment cost. Okay, that's don't forget here we said B and D, they're mutually exclusive. Okay, therefore we can only invest in one of them, but not both of them. Okay. Okay. Then in case they are what we call independent, then it doesn't matter which one you take. They're independent of each other. Okay. Okay. Now, what if they are indivisible? That's the next question you want to answer. What if they are indivisible? If they are indivisible, we use trial and error method. If they are indivisible, we use a trial and error method until we get the combination, okay, that is going to give us the maximum possible NPV. If they are indivisible, that means you must invest in 100% of the project, then you can only do so. When it comes to making the decision where to invest your money in, then you can only do so based on which of the combination. But pay attention to, for example, the 10 million half year, that whatever combination we'll be choosing, ought to ensure we're not going to be using more than 10 million, but the combination that gives us the sum of the highest NPV, we can therefore the optimal investment schedule. For example, let's assume that these were indivisible. Okay, we want to assume that if this question, because I don't think the examiner has ever asked that question. I'm not sure, but let's see. I can't remember the question. Let's go to the question bank. Okay, I've not seen a question the examiner is asking that of the case of indivisible project. Control F, indivisible. I don't think. Yeah, there's no. I can't see any question. Okay, so let's assume that these were indivisible. Okay, so let me go back to Excel. Therefore, let's assume they were indivisible. They were indivisible. Okay, all of them. But let's even assume. Let's just take A, B, and D. Let's take A and B. Let's assume that the E was not there. So if they were indivisible, then you can't rank them based on the PI. You can't use PI in short. However, you're going to be we will be looking for the combination between A, B, C, and D that is going to give the highest possible NPV. Okay, let's even assume that B and D are independent. They're not mutually exclusive. Okay, they're independent. Then assumption I'm trying to make. Okay, so we use a trial and error method. Okay, so we can take, for example, okay, let's assume, okay, let's say initial cost in amount available, capital available is 5 million. Okay, that's what we're going to assume. 5 million. A, B, C, D, they are independent projects. Okay, they are independent projects. None is dependent on the other. Okay. And the other factors remain the same. Everything remain the same. The NPV, initial cost remain the same. Okay. Now, what if I want to look for a combination again to give us higher NPV. So if we do, okay, if we do A, B, C, and D, assume you want to invest in all of them. A, B, C, and D, the total amount you must have is 9.2 million. We can see that point. If you invest in A, B, C, and D, all of them, okay, it would mean you require to have 9.2 million, which this company doesn't have. This company has only 5 million. So we are in a capital rationing situation. Okay. But then before you even start rationing the capital, before you start even ranking them, get to know, are we in a capital rationing situation? Because if the funds are available, there's no capital rationing situation. If, for example, the sum of this A all the way to D is equal to 14.2 million. If the funds available was 15 million, then you don't even need to rank them. Invest in all of them, of course, except B, because B and D are mutually exclusive. Okay. So the first thing to note is that, are we in a capital rationing situation? You compare what's the funds available, 10 million. What if you have to invest in all of them? Okay, the ones that are investable. Okay, it would require 14.2 million. Therefore, you're in a capital rationing situation. Anyway, either way, B, C, and D, the one you just mentioned. Okay, let me just put this here. It is. Let me just pick this. Okay. Okay, B, C, and D. This is the NPV. Same way. This is initial cost. Okay, and these are the projects. Okay. So we want to determine how do we allocate the 5 million among A, B, C, and D. So what if we take A and B? Let's just take A and B. A and B would consume, okay, I'm just trying to, I can highlight and see the sum. A and B would consume 4.7 million. You can't take C and D. Do you get it? Because your limit, your cap is 5 million. So you can take A and B. Okay, that's the first trial I'm taking. So A, B. Because AB initial cost is 4.7 million. Okay, so the true amount, let me call this cash taken or amount invested. Yes, amount invested. So amount invested, okay, in AB will simply be equal to sum. Okay, just call it sum. Okay, sum of AB will be equal to 4.7 million. So it is not yet 5 million. So we are safe in quotes. Okay, the NPV would be equal to the NPV would be equal to the NPV of those two, will be equal to sum of the NPV, and you get 2550. Clear there? Sanya, is clear?
Sir, can you please repeat?
Okay, you're saying that we want to use a trial and error method. Okay, so my first trial was, what if we take A and B? If we take A and B, the total amount you'll be consuming will be equal to 2.5 plus 2.2 to give us 4.7 million. Don't forget your limit is 5 million, isn't it?
Yeah.
The NPV will be seen in case you do A and B will be equal to 1 million plus 1550 to give us 2550. Clear
Okay.
there?
Yeah.
Okay. Now next trial, okay, is a trial and error method. Don't forget. What if we take what A and C? Can you do it A and C? You can't take A and C because A is 2.5, C is 2.6. The two combined will consume 5.1, which you don't have. So you can't take A and C. Okay, so A and C is out. Okay, let me just put it here. AC, but it's out. So the initial cost is equal to 5.1 million. So you can't invest in AC. Okay. So what if you do A and D? Yes, I think that one is possible. So AD. So AD, the initial cost will be equal to A is 2.5, D is 1.9. So the two consumes 4.4 million. The NPV to be received will be equal to A 1 million. Okay, D 1.5. To give us 2.5 million to be the NPV to be received if the company chose A and D. What if we took B and C? Can you do BC? Yes, you can do BC. Okay, if you do B and C, okay, so this is BC, the initial cost should be equal to B 2.2, C 2.6. So still we not beyond the 5 million. So yeah, okay. The NPV will be equal to BC, that should be the NPV. Sorry. Will be equal to simply the sum of BC to give therefore 2900. What if we do BD? Can you do BD? Yes, you can do BD. Actually, you can do BD. BD, okay, the cash to be consumed will be equal to 2.6 plus 1.9, 4.5. Okay, the NPV will be equal to B 1.5, BD to 1. Now that way. Every day that's 50. Okay, that in case we take B and D. Okay, what if we take what else? CD? We can do CD. Okay, CD can do. Is it worth investable? BD, what do we do? B and D, and that's okay. C and D will be consumed. BD, we made a mistake somewhere. No. I guess I've made the initial cost for BD is how much? Is equal to B, D. Yes, 1.1. Okay, yes, there's a mistake there. So CD will be equal to Okay, CD initial cost to be equal to the sum 2.6, 1.9, NPV will be equal to CD will be equal to simply the sum also of these two.
Sir,
Yes.
so we can't take B and D because they're mutually exclusive.
Oh, so here we assumed in this part that they're all independent. Can you see this part here?
Oh, okay.
Yeah, for this part we assumed that they're all independent. Yes, we assume that they're all independent.
Okay.
Okay. Any other combination which I think I may have overlooked? Any other combination? I think that is it. Okay, I think that is it. Okay. So based on that, then we can still make a decision. We can advise the company where they should invest their money. And I think the company, they should invest in BD. Okay, assuming that they're all independent. Okay, therefore, the company should invest. Okay, should invest in B and D, since the combination will give the highest sum NPV, the highest sum of NPV. Okay, we can take B and D since the combination give us the highest sum NPV. Okay, assume that they're all independent. Actually, here I think we didn't give an advice. Are we meant to give the advice? Anyway, I can give the advice. The company should invest in. We said. You can say E. Okay, which is an AE in project. E is a must, so you may want to include or not include it in your comment. So E, C, D, N. So A, C, D, and 20% in A. Well, this was 20%. Okay, so 20% in A. Why was it 20%? You forget it was 20% because it was, and you have to show you, it was 500,000 divided by 2.5. I think it was 20%. Yeah, 20%. Clear? Brian, it's clear?
Yes.
Okay, and so therefore we make a decision when we are in capital rationing situation. So first, get to know, are they divisible or are they indivisible? Okay, the divisible, indivisible. If they're divisible, we use the PI method. If they are indivisible, a trial and error method. Any other question? Any other question? Okay, no question. Great. Okay, that's therefore marks the end of capital budgeting decision. Capital budgeting decision. Okay, so if there's no question, then you go to the next part of the syllabus, which is on financing decision, Okay. Don't forget, as I mentioned, don't forget there will be a question in the exam, okay, when it comes on the project, on the capital budget decision, on investment appraisal, there will be a question, either section B, anywhere, okay, it can appear, mostly in section B and section C. So expect a question in the main exam, okay, on that area. That means for sure. That was a guarantee. There'll be a question. Mostly NPV, IRR, mostly. The next, therefore, major topic we are going to discuss is on finance sources. Okay. And if you remember, when we were discussing the introduction of the syllabus, we mentioned that there are three core decisions that financial management covers. Okay, financing, investment, and the dividend. So now we are in financing decision. Okay. The first bit is true. The first key question that ought to be answered at a financing decision is the finance sources. Okay, where will the money come from? Okay, who is going to finance as money? Okay, so the money can come from different diverse sources. Okay, they can come from diverse sources for the company. Okay, so let's first do a simple graphic of it. Okay, so finance. Just a minute. Okay, so finance sources, we can classify them into main category. We can classify them into main category. We have long-term and short-term. Call them finance sources here. Okay, you have here long-term finance sources, and you have short-term finance sources. For the short term, we have how many? Maybe 4 finance sources. You can use, for example, the use of trade credit, that is getting money from your suppliers to getting goods on credit from your suppliers, okay, which you have done at the payables. Okay, we have the use of short-term loans, short-term bank loans, the use of overdraft. You can also use what else? Leasing, which I think we have discussed. You can also use leasing as a finance alternative. Okay, we have discussed this. Okay, so we'll only be discussing these two. There is of short-term loans and there is of overdraft financing. And in the case of long-term finance, okay, I think I need to.
Yeah.
Yes.
Can you say money market?
Money market as a finance alternative. Actually, it can be one of them. There is overdraft as well as the use of money market. Thank you. Yes. The use of the money market. Yes, can also use the use of the money market instruments, okay, commercial papers. Yes, it's actually one of the way of financing. Yes, thank you. In the case of long-term finance, okay, let me just bring them down here. Long-term financiers, again, classify them into anyway. The first will be the use of equity, which of course the conventional way of financing using long-term. We have the use of debt, definitely. Okay. The use of preference shares can be of financing. Also, the use of venture capital. In the case of equity finance, okay, the use of finance means equity. We have the two major finance sources could be the use of the company retained earnings. This is the company use of company past earnings, retained earnings. And also the use of company issue of shares. In the issue of shares, you can issue shares through a number of ways. Okay, you can use, for example, IPO, the initial public offering. We have the use of placement, we call private placement. Okay, the use of introduction, the use of rights issue shares, the rights issue shares. You can also have secondary share issues. Okay, so the number of ways that can be able to obtain through the issue of shares. Okay, we shall discuss each one of them in detail. In the case of use of debt finance, okay, let me just. In the case of debt finance, you can finance using a number of ways. Okay, you can finance, for example, using long-term loans, using long-term bank loans. Okay, you can also use the case of bonds. Okay, in the case of bonds, don't forget the number of bonds you can issue. Okay, you can issue, for example, straight bond. Straight bond means they don't have any attachment. They're simply bonds, nothing else, with no add-ons. You have to use a term. Okay, straight bonds. We have what we call straight bond, also referred as the conventional bonds. Conventional bonds. We have the case of what else? Convertible bonds. Now, these are bonds that have the option of conversion. Okay, as an add-on, they can be converted into equity shares. Okay, they are debt instrument. However, within their life, okay, as a holder, if you want to convert them, you can decide I'll convert them from being debt instrument into equity instruments. Okay, we have that option. We have what you want to know? Bonds that are irredeemable. That means therefore they don't have point of redemption. That means therefore, as a holder, you as the one who is going to, you as the investor in this company, the company guaranteed will pay you every year to infinity an X amount of money. However, they'll not be returning back any capital to you. Okay, It's just like equity. Okay, there's no return of capital. Then you have bonds that are redeemable. In this case, there's an option of redemption that imply, therefore, before the life of this, there's a net life, in short. Okay, there's a net life to this particular bond. Okay, there's a net life to this particular bond. Okay, so it can be issued for 10 years, for 30 years, but at the end of the life of the bond, the company will have to refer back. Is it referred? Yes, some sort of get back or pay back. Okay, the amount they borrowed at year 0. Okay, because bonds that are redeemable. Okay. So we shall discuss all these bonds, okay? Okay, we shall discuss them in detail in this topic, okay? And that's is what we shall
So
discuss.
where does
Sorry?
corporate and treasury bonds lie?
Sorry?
Corporate and treasury bonds.
Okay, you can have case of government, the government can issue what referred to as the treasury bonds, okay? They can be financing for the case of the government. Sure, it is financing for the government, okay? Not for a commercial company, but it can be for the government, okay? What do you call the commercial bonds? Okay, these are going to be issued by the company itself. Okay, commercial company. Okay, they are issued by commercial enterprise, and all these are all these are referred to as commercial bonds. Okay, they issued by a PLC, public listed company.
So these are the examples of commercial or corporate bonds.
Yes, commercial company or corporate bonds. Yes, they are. Okay.
Okay.
Yeah.
Thank you.
Okay, so that's what we shall be discussing in this topic. Okay, therefore we go straight to topic 1. We go straight to discussing the short-term finance sources. Okay, as I mentioned, we're going to discuss loans and overdraft. Okay, then after that we go to long-term, then we go to try to look at each one of them. Okay. Okay, so the finance source. Okay, I think we have already mentioned. We have discussed it together. Okay, you can have a case where we want to determine where the money will come from. Okay, as I mentioned, they can be from short term, they can be from long term, they can be from equity, they can be from debt, preference shares. Okay, they can be from many diverse sources. Okay, so the idea, okay, you may, as we shall discuss it alone. Okay, is consider one of the key factors you might consider when making the choice of which finance alternative we ought to take. For example, would be the interaction of the current finance you have with the new finance you're issuing. Okay, if, for example, currently you have an agreement with the bank that you're not going to get any other loan, that means, therefore, even if currently you want to finance a project, then you have to consider what is the interaction of this new financing with already pre-existing finance sources. Okay, you may want to have to consider. I'll pull that into consideration, for example. Okay. So what are the factors you consider? Okay, some factors you might consider, for example, okay, could be the cost. That's definitely a major factor you need to consider. The cost of financing. Okay, how much return do the provider of capital expect? Okay, because that's a factor to consider. That in case I was finance this investment using a loan, okay, how much interest does the bank expect? If I'm going to use equity, how much return do the debt holders, equity shareholders of the company expect to get? Okay, so of course is one of the major factors that we consider when making the decision as to which finance alternative we have to consider. Okay, do we take debt? Do we take loan? Do we issue preference shares? Do we take short-term loans? So you have to consider what is the cost. Okay, what's the cost? It's one of the key factors you need to consider. The next thing, of course, is duration. Okay, how long is this? First, consider what is the life of the project, for example. Okay, because in case you're going to be investing in a project with a life of 10 years, does it make sense for you to finance using a short-term loan? Because this investment is 10 years, then how do you finance in a 1-year loan? It doesn't make sense. Okay, so as we shall discuss it alone, we'll call the matching policy. Okay, actually, I think we have already discussed it together, the working capital. Okay, that you have to consider, you have to match, in short, okay, the life of the asset, the life of the project with the financing strategy you're taking. Okay, so in case the life of the investment is going to be 100 years, then you can't finance. It's better to finance in equity as opposed to use of debt. Okay, because to lock yourself in paying debt for 100 years is could be quite risky. Okay, so you may want to consider: do you use government finance? Do you use grants, for example? Okay, because if an investment could be for life of 100 years, that is quite an eternity in quotes. Okay, so you may want to therefore consider an investment where there is no obligation to be paying, let's say, an interest or so. Okay, so you may want to finance, for example, using equity finance. Okay. If, however, you're going to have a life of 10 years, an investment of 10 years, then you match it with a source of capital where you'll be paying the life of that source of capital is also equal to 10 years, the life of the project. Okay. I think it's called the term structure of interest rate. Term structure of interest rate. Okay, how will the interest rate behave? How will the interest rate or the yield, okay, within the different bonds behave? Okay, you want finance using debt. Okay, bond, issue of bond. So consider how does the different life of the different bonds behave? Okay, for example, just give an example to explain the point. Hope it becomes much clearer. Here, for example, this being the term structure of interest rate, okay, we'll call the normal yield curve, okay. What happens is that we have in this with the case, okay, that this is time, this is the cost, or this is a return, or this is a yield, the yield to the investor, okay. That means therefore, this is called a normal yield curve. It's called a normal yield curve. What does this particular graph illustrate is as time goes by, okay, if, for example, the company has issued a 5-year bond, the cost to the company is equal to X amount of money, okay? A 10-year bond is equal to X, or will be, this is equations, okay? Will be equal to that particular amount. So that means, therefore, if you have to issue a 5-year bond, it will be cheaper to the company, okay? If you have to issue, for example, to issue two 5-year bonds, as opposed to issuing of a 10-year bond, okay? So it is better for the company to finance its need by issuing a 5-year bonds. Why? Because the interest they're paying, okay, which is the yield the investor expect, is lower than a 1-year, 10-year bond. Okay, that's the case of a normal yield curve. In case we are called an inverted yield curve, okay, we refer to as inverted yield curve. Okay, or called downward sloping yield curve. Downward sloping yield curve. Yield curve, okay. Well, that illustrates that as time goes by, okay, a 10-year bond is cheaper than a 5-year bond. So in case you have a need for 10 years, then it is better to finance using a 1-year, 10-year bond. Why? Because it's cheaper to you. If you take a 2-year, 5-year bond, it is more expensive, okay, as opposed to the case here where you say that a 5-year bond, 5-year bond is cheaper because you're paying less. But here is the reverse, okay. You're going to be paying more in case you take a 5-year bonds. So therefore, if your need is 10 years, then it's better to finance using a 10-year bond. Why? Because the yield is a bit low. Your cost to the company is a bit low. If you have a bond that is, if the yield curve is so-called, this should be straight line. Let me try to do it better. If you have called a flat yield curve, which is flat, also flat for my case. If you call this, then in case that's the yield curve we have in the market, we'll call a flat yield curve. It doesn't matter. Flat yield curve, it doesn't matter whether it's a 5-year bond, a 10-year bond, the interest remains the same. Okay, the yields of the required return by the investors is the same. So you can take up. It doesn't matter per se. Okay. Then you have, of course, a case we call humped yield curve. So it's quite unpredictable. This is like a yield curve that's unpredictable. It can move up and down at any point in time. Okay. So therefore, that becomes a bit more. What do you say? It comes to predict and to come to be able to make decisions regarding when to issue or what the life of the bond will be issuing. Okay, in consideration of the cost, okay, it might be a bit shaky because the yield curve can move up and down at any point in time. There's no any defined route it can follow. Okay, so you have to consider therefore what's the yield curve. Okay, what's the term structure of interest rate we have in the market. Okay, if it's normal, then you may want finance, for example, to break down. Okay, finance using maybe short term as finance using medium term bonds as opposed to long term bonds. Because medium term bonds, 5-year, 10-year, they are better than 20 years, 30 years, or even 40 years bond. Clear? DC is clear. DC is clear.
Yes.
Okay, great. Okay, so consider therefore what's the yield curve? Is it normal? Is it the downward sloping yield curve? Okay, what's the yield curve? Is it the flat yield curve? Okay, so you have to consider to forecast. In short, this is more toward forecasting. Okay, which yield curve will be applying in the market then? Okay, the factor we want to consider is a gearing, which I think I've mentioned already. Okay, for example, we want to consider what is the interaction of the new financials I want to acquire with already existing financing already have. Okay, if you have a prior agreement, for example, with the debt holders that you cannot get more debt, that means therefore you may want to get finance with debt, but you can't. Both already the pre-existing contracts you have with your current debt holders, for example. Okay, So what's the interaction? What would the impact, okay, of the finances have on the gearing? Okay, is it going to, in quote, land you in trouble as a company, okay, with the already existing provider of capital you have? Okay, then you have, is it accessible? Can I be able to finance using that particular finance option? Okay, you may want to finance using bond, but you can't do so in case you're a private company. Okay, you must be a public listed company if you want to finance using a bond. So consider, can I be able to finance myself using that finance alternative? It might be cheaper, but it's not, it's way out of your league, in short. Okay. So those are some of the factors you want to consider when making a decision or which finance alternative you ought to take or you would want to finance yourself using. Yes, Sakina.
Yes.
We said you can finance using long term and short term. For the short term, okay, there are 4 or even 5, maybe you can call it, okay, because you can have a case of hire purchase agreement. I mean, hire purchase can be also a finance source, okay, hire purchase, okay, but it's a form of like, okay, hire purchase, lease. Anyway, hire purchase can also another finance source you can have through hire purchase. But anyway, the main will be what we shall be discussing will be overdraft and the loans. The other 2 we have discussed together. Let's begin therefore with the overdraft. Now, for the overdraft, this is a case where, as a company, maybe as a company, they will be financing and also an overdraft. An overdraft is an agreement between the company and the bank, which is this be a financial institution, where the bank is willing to extend money based on already pre-agreed upon limits. Okay, so you go to the bank. Okay, you go to Barclays Bank. Okay, the Absa now. Okay, you have a request that, hey, I can overdraw my account until a limit of, let's say, 1 million. Okay, that implies that we as a company, you can finance your need. Okay, you can be able to overdraw your account until that 1 million you agreed upon. Which implies, therefore, the bank will charge you interest upon your withdrawing. Okay, so if you don't overdraw your account, that implies, therefore, it's like you have not, you're not, there's no overdraft here. Okay, it's like a case of they have the so-called credit cards. Okay, it's the same concept. Okay, the use of credit cards. Okay, it's like an overdraft. Okay, you have agreed upon with the bank that, hey, your limit for this credit card is, say, 100,000. Okay, so you can overdraw until that 100,000. Okay, so it's like the case of the current modern way of credit cards. Okay, you can pay it alone. Okay, and of course the interest will be charged on you. Okay, based on the amount that you have overdrawn. Okay. So if a company is always all of that, when does the bank therefore repay itself? Upon cash in quote entering or being credited to your account. Okay, once the money becomes credited to your account, the bank therefore repay itself. Okay, or the amount that enters or the amount that comes into your account. Okay, that's the idea. So the bank repay itself first. Okay, of course the amount you've overdrawn plus the interest applied applicable on that particular overdrawn amount. Now, if a company is always in the overdraft, okay, it can happen that this month you withdraw the account, the next month you take another withdrawal. So if that's the case, therefore, where there's going to be, it can be a concern even to the case of the bank. Okay, they can ask you, hey, why don't you just convert your overdraft to a loan? Okay, which don't forget, overdraft is a bit expensive. Okay, not like the conversion loans. Okay, it's a bit expensive because you pay I think on a daily basis. Okay, so it's quite expensive. Okay, compared to the case of a conventional loan. Okay, so the bank can make that request that you are in a solid core overdraft situation. Therefore, why don't you just convert your overdraft into a loan? Okay, for the sake of our own management as a bank. Okay, as well as for the sake of your own management as a company. Okay. Then you have the case of short-term loans, okay, where this is going to be a formal agreement, okay, you have between the bank and the financier, where the bank extend money, okay, immediately upon the conclusion of the contract, okay, and take maybe 24 hours immediately upon the verification of the loan application, and it depends the bank from bank, okay. However, the amount you get immediately, you do get immediately upon, you get it today. Let's use that term, okay. You get the amount today. For the overdraft, don't forget you don't get the money today. You get the money upon overdrawing, okay. In the case of the loans, okay, they may have advantage in terms of planning purposes. Why? Because for the loan, there's a fixed amount that is payable, okay. I pay, for example, 1% per month, 1.5% per month, whatever the interest you do pay, okay. But the interest is predictable for you as the borrower, as well as for the lender, in this case, the bank, okay. For the overdraft, the interest can increase in time, okay. This month can be 2% per amount overdrawn per month, okay. next month can be 2.5. So there is no any guaranteed upon interest that the borrower as well as the financier, okay, has fixed. Okay, so therefore it's kind of really unpredictable. Okay, and that's why I say that sometimes maybe short-term loans could be better than overdraft. But either way, you have to consider what's the situation. Okay, if your need is going to be, I don't know, you don't have those frequent needs, okay, as a company. However, sometimes they can arise, then you may want to enter into an overdraft. Okay, so that just in case, okay, the need for capital is going to be more than what you have, you can now be able to overdraw the account. Anyways, the interest, as I mentioned, for the case of overdraft, you pay upon overdrawing the account. So in case you have not overdrawn the account, then you don't pay the interest. Okay, but you pay what we call an upfront fee, okay, commitment fee, okay, for the bank to commit to be paying you. Okay, so it's asking for money. Hey, you want a commitment that you can overdraw your account anytime that you want. So they ask for a commitment fee, definitely. Okay, so you pay also, but the interest you pay upon the account being overdrawn. Okay. In the case of short-term loans, don't forget you pay upon once you get the money. It doesn't matter whether you use the money or not. Okay, the interest are accruing on the spot. Okay, immediately. Okay. Any estimation, there could be advantages to get as loan, or the advantage that to get in case you do take an overdraft. So either way, consider what is my situation. What's better for me? Is it a short-term loan or an overdraft? Okay, don't forget both serve the same purpose. Either way. Solution in the case of interest repayment are more predictable for both client and the bank. I think I mentioned that in the case of loans. Okay, you know that I'll be paying every 5th of the month. Okay, so before that, the bank cannot ask me to pay an amount. Okay, so when to pay is quite predictable. You know, okay, as the bank knows, and they cannot come and ask you to pay before that. However, for the overdraft, the bank can make a request that, hey, you've taken your account was overdrawn last week. We need you to reset your account maybe in 2 days' time. So the bank can make that request. So there's no any point upon which is predictable for the borrower for the company. Okay, the request of they can be asked to pay the amount anytime in point. Okay, depending of course the bank. Okay, but of course the risk that the bank thinks that you have. Okay. So there's no also the risk of account being withdrawn prematurely. Don't forget the bank can do that. Okay, in the case of the overdraft, you can say, hey, we suspend your account for withdrawing for the next 2 months. Why? Because you take too long to pay us the money. They can do so. Okay, they can't do so in case of loan. You have the money. You have the money already either way. Okay, so the best they can do is they can auction the property in case in case there's any security they had asked previously. Okay. In the case of loans, overdraft, it has advantages, of course, also in case of loan. For example, the interest you pay when you withdraw the account. Okay, there's a way more flexible because you can simply renegotiate the terms and conditions with the bank to increase the limit from 1 million to 2.5 million. You can do so. Okay, it is possible to negotiate the terms with the bank. For the case of loan, you can't do that. Okay, you have to enter into a new loan agreement altogether. Okay, you have to enter a new loan agreement altogether. Okay. But you can refinance, okay, like restructure the loan. Okay, it's possible sometimes. Okay, there's a little bit of flexibility, not that often. Okay, I think you see that case with the bank right now. They do restructure the loans. Okay, I can't go to pay you money. Why? Because of COVID. So they can ask. They can also. It's possible for them to restructure, but the flexibility is more. Okay, in case you do take an overdraft as opposed to the case of short-term loan or the case of loans. Question so far on that bit? Okay, no question. Then that's for short-term loans, short-term finances. Then you go to long-term finances. Okay, beginning off with a debt finance. Okay. So maybe the question you want to answer is, why should the company go outside of itself to get the money? Okay. Or maybe it could be some reasons. Maybe in case the shareholder say that you're not going to finance anymore. You have not paid us dividends for the last 5 years. Why do you want to get us more money from us? Shareholder can say, you're not going to finance that. So you as the management, okay, the board of directors, then you may be forced in court, okay, to go outside the company to get the money. Okay. Also, in most cases, it is much easier to access or to be able to finance using debt as opposed to use of equity. Why? Because equity to issue, they do have so many intricacies. Okay, so many stages you need to pass through before you can go to the market and issue shares, for example. Okay, NSC will be there, the CMA will be there. Okay, you need approvals from. There's so many things you need to get. You need to pass through. Okay, by the time that you're going to have a case where you can issue shares. Okay, so as opposed to going to the bank and asking for loan. Okay, it's much easier. Okay. So because of the stages, because of the intricacies, because of the different modalities involved in issue shares, okay, people avoid them. Okay, sometime. Okay, especially in case you want to convert from being a private to a public company. Okay, there are some things you need to consider before you do that. Anyway, also that also provide tax relief. Okay, that one's for sure. That because of interest you pay is a tax deductible expense. Now, when making a choice between different debt instruments, okay, should we take a loan? Should we issue a bond? Should we issue a commercial paper? Well, all these are debt instruments. Don't forget, okay, they're all debt instruments. Okay. Now, what factors you consider? Of course, the first thing is it available? You may want to decide to issue a bond because they may be cheaper. Okay, maybe at that point in time. However, are you listed? No, you can't therefore be able to access that finance. Okay, so therefore you can. The only available alternative you can have is go to a bank and borrow money. Okay, you want to issue commercial papers, you can't do so in case you're not listed. Okay, you must be listed before you can be able to do so. Then of course the duration, I think I already mentioned that. Okay, the duration of the project was the duration of the loan. Okay, that debt alternative you have. Okay, because in case you want to invest in a project that has a life of 30 years, then you can't issue commercial papers. Okay, that means for sure you can't do so. Yeah, what do? You can only be able to do so through maybe that year bond. Okay, so you try to match because of matching also applies even here. The terms of interest rate, okay, I already mentioned that. Okay, the exorbitant regarding the interest rate movement. Okay, the terms structure of interest rate. Okay, I discussed that already. And the next is on the security. Okay, does this finance alternative require security? Okay, and do I have it? Okay, I want finance using debt. To finance using debt instrument, using bond, for example. The board holders are asking for a security. Do I have it? Okay, I want finance using loan from bank ABC. Okay, do I have the security they're asking for? Okay, because if you don't have, then that can hinder you from being able to being able to obtain that debt finance. Okay, I want to obtain personal finance loan. They're asking for my payslip, and I'm currently unemployed. Okay, therefore, the security also may determine what therefore could determine whether you can be able to finance them yourself or not. And of course, covenants. I think I already mentioned about covenants. The agreement you have with the previous debt holders. Okay, what does it say? Okay, does it put some restriction on your future borrowings? If it does, then have we gone against that provision? Okay, because in case you have, then you may have to consider either decide to negotiate with them, or you can finance yourself using the new debt you want to use. Okay, so those are the factors that you may want to consider when it comes to debt finance. Okay, when it comes to debt finance. Now, one of the major finance sources is the bond. The major debt finance source is the issue of bonds, the issue of bonds. Okay, and I've mentioned for the bonds, you need first to be listed company. Okay, your shares must be trading on the floor of the NSC. In the case of Kenya, for example. Okay, the long term, okay, definitely their life is going to be maybe from 5 to 30 years. Okay, that's the conventional life of common bonds. Okay, 5 to 30 years. Okay, that's conventional bonds. Okay. The issue par mostly be either at 100 or at 1,000. That's the par value, okay, of most bonds. Okay, these are dollars here, not shillings. Okay, they're going to be that. Give me a minute. I need to power. Okay, so the more conventionally be par value of 100 or par value of $1,000. Okay, so consider what you're being given, because today's question will have its own par value. So conventionally it's 100. If there's no mention, then assume it's 100. Was a negative case where the exam doesn't mention what the par value. Quite unlikely, but in case it happened, I would assume the par value is 100, the par value of the bond that is on issue. Of course, the interest is fixed; it's not variable. Okay, all bonds pay fixed. Okay, and therefore, since they're paying fixed, therefore, what makes the market value to fluctuate? The market value of the bonds, okay, to fluctuate is the current or the trading, okay, the rate applicable in the market, okay, because the discount rate, okay, is the prevailing market interest rate, okay, that's the discount rate we normally use for getting the market value of the bond. Shall come back to it later on, okay. Okay, this mention. This is the market because therefore the market value of the bond fluctuates. Okay, based on the interest rate, but the interest rate remain fixed. The interest that you receive is fixed. Why? Because the interest rate here is fixed on every bond that is issued in the market.
So, sir,
Mm.
the value for the bonds, the par value, is determined by the market and not the company itself.
Now the
Like, sure.
the par value of the bond, it's you as the issuer. Okay, determine what's the par value of this bond. For every instrument I will be issuing in the market, how much money do I want? It's you to determine that. But convention, as mentioned, is 100 or 1,000. So the market doesn't determine the par value of the bond. The market determines the market value of the bond.
Okay.
Yes, so the par value is you as a person issuing. Okay, you determine. Okay, for every bond I want to issue the market, how much do I want to receive? Okay, as I mentioned, conventionally, either 100 or 1,000. Okay.
So if the market value changes and you do not want to change your par value,
the par value is fixed. No, the par value of the company, the par value of the bond is fixed. It doesn't matter. It's not dependent on the market value. So if you issued at 100, that's gone. That's history now. Do you get it? Like for example,
can you repeat?
Let me give you an example. The case of your company here in Kenya called Safaricom, they issued their shares at 5 shillings per share. Okay, Kenya shilling per share. So that is history. That's now history. Okay, the par value remains as it was because it was issued at 5. You can't say that for sure. But then that's now past, isn't it?
Yeah.
Yeah. So the par value is the point at the point of issue. Okay, you issued in 2020. Okay, was how much did you receive per bond? 100. Tomorrow you can't change the par value because that's the par value was issued yesterday. It was issued yesterday, so you can't change it yesterday, isn't it?
Yeah. So the interest will be determined by the market value.
The interest you receive is not determining the market value. The interest you receive as a holder is dependent. Don't forget, as a company, it will go to the market. It's like you have a product you want to give the market. Okay, so you tell the market, hey, this is my product. Okay, the par value I want you to give me 100 shilling, and every 100 shilling I'll give you be given to me. I'll be giving you 10% of that. So the interest you receive as a holder, as the investor, is what you agreed upon at the beginning of the time. So the interest is not going to be varying. It's what we agreed. You get it?
Yes, kind of.
Yes, the cash flow you'll be getting, you agree upon at today. When how much money do you want from me? I want $100. Okay, how much is going to be given to me? 8% per year, fixed. So in a year's time, you can't come back and tell me I want more interest from you. No, because as per the contract you have, I'll be paying you 8% of $100 you gave to me. You get it?
Yes.
Yes. So the interest you receive is fixed. The interest you receive is a fixed amount. Okay, it's not going to fluctuate from year to year. However, the market value is fluctuating. Okay, because because of the supply and demand. But maybe in future, more people will be demanding that particular instrument. Okay, so the price therefore be increasing or decreasing. Okay. However, it is not the interest is to be received is a fixed amount. Is fixed. The interest rate is fixed. Therefore, the amount to be received is fixed. Clear?
Okay. Yeah.
Okay. Now, debenture, you have something else called debentures, okay? Debentures, this is essentially is what we call unsecured bonds, okay? They are what we call the unsecured bond, okay? So for most bonds, okay, they are secured against the asset they are financing. If, let's say, Kengen, okay, the company bond that makes, okay, is used, let's say MTN, okay, same MTN, okay? So if you have to issue a bond, okay, what they're going to issue the bond against a security, okay? This money will be used to finance, I don't know, expansion towards this particular market. So the holders, the investors, secure their finance, their debt finance against that particular asset. If you don't pay us, then we as bondholder have a right to go and dispose of the asset use of money finance. Okay, but you can have a case where there is no security. Okay, it's a bond but no security attached to it. Then refer to that as a debenture. Okay, or the unsecured bond of a company. Okay. But the other features are exactly the same. The difference between the bond and a debenture is simply on security. Okay, if the bond is unsecured, then we don't call it a bond as per se. We call it the debenture. Okay, refer to it as a debenture. Clear? Now, I think you mentioned the number of bonds you can have. Okay, you can have, for example, a deep discounted bond. Okay, let me just make a mention on this bond. Okay, now generally, some kind of case where we have mentioned that conventionally the bonds are issued at their nominal value, par value, of let's say 100. Okay, so you as a company, you may decide we're not going to issue at 100. Okay, we want to give, we issue them at let's say 90, maybe $95 per bond. Okay, but the par value is 200. Okay, but we issued at 95. That means therefore you give the holder, okay, this is the par value of the bond. This is the issue price. Okay. Which therefore mean therefore that you as a company, the issuer, okay, you gave 5% discount. You issued your bond at 5% discount to its par value of 100. So if currently, let's say in the market, this particular market, we only have two issues, not two issues, let's say like three issues, okay, issued by company A, by company B, company C. Company A, they issued at 5% discount, company B at 3% discount, company C at 8% discount. Then we can say therefore that the company B bond is a deep discount bond. Why? Because if you compare with the most recent issue, it is issued at 8% discount compared to an average of, okay, what's the average here? An average of 4%. This is 16 divided by 3, an average of 5%, okay, because the issue, okay, of company C is at a very high discount compared to the most recent issues, a deep discounted bond, okay, and this is what the discount, the issue price compared to the nominal, okay, compared to the par value, okay. Then sometimes you can have bonds that don't pay any interest, okay, they have zero interest return to the holder. We refer to them as zero coupon bonds, okay. As a holder, you don't get interest, okay, within the life of this bond, okay. What you'll be getting is a capital gain, okay. Maybe the company have an agreement that, hey, we issue bought today, 2020, we redeem it in 2030, okay. Between 2020 and 2030, we pay you zero interest. However, in 2030, you give us, in 2020, let's say you give us $80. In 2030, you'll be paying you $120 per bond. Then between years 2020 and 2030, the return you'll be getting per bond, therefore, is equal to $40 per bond. Okay, the call as your bond. So therefore, you as a holder, the return you get is simply on the capital gain, but you don't get any interest. Okay, between 2020 and 2030.
Sir, so the $120, is it determined in 2020 or 2030?
This is as per 2030. So definitely, because time value, of course, you don't get, this is not time value, be maybe 30, maybe, okay, based on today's value, it could be 30 per bond. But this is as per 2030, not today's value.
Okay.
Yes. Okay. Then I think tomorrow we pick from here convertible bonds. Okay, we discuss from convertible bonds from tomorrow, that is. Any question?
Sir, can you please explain zero coupon bond again, please?
Zero coupon bonds, okay. Zero coupon means that there's zero interest you'll be getting within the life of the bond, okay. So this bond doesn't pay you any interest, okay. However, the return you'll be getting will mostly be in terms of a high capital gain, okay, like in this example here, okay. So between the year 2020 and 2030, you don't get any interest. No, the bond pays interest every year, okay. Actually, not every, okay, they pay every 6 months, okay, every 6 months, okay. However, for the zero coupon bonds, you don't get the interest. Okay, so as per the agreement. However, the company paying you a high capital gains in the future. They buy, you give them 80, they give you back 120, for example.
They give back what?
120.
And what's the 120?
No, the company, don't forget, at year 2020, the company went to the market and told you, hey, give us $8 today. We are going to give it back to you, in quote, okay, in simple terms, in 2030, not at 80, but at 120.
Oh, like you pay them extra.
Not you paying them,
Or
okay, yeah,
something like
you as a company, you as the issuer, yes, you'll be paying them $120 for every bond they bought from you, yes.
Okay, okay.
Clear? Okay, great. You have a question?
So about debentures,
Mm.
can you repeat what unsecured means?
Unsecured means therefore that there's no security, there's no collateral underlying the bond. Okay, if for example, normally in case you go to a bank, the bank would ask you, you want how much money from us? You want 100 million from 100,000 from us? Hey, we're not going to give you without a security. Give us a security. Okay, give us an asset just in case you fail to pay us. We as a bank can come and dispose of that asset and we pay ourselves. You get it?
Yeah.
That's
Okay.
called security. Okay,
So for bonds, you need to give a security.
Generally, what happens in the case of bonds is that the asset you'll be using to finance, you as a company, you go to the market, tell the market, I am going to issue a bond to finance, let's say, to finance this factory. So the bondholders will be their bond is secured against the factory you're going to be financing them. You're putting money in. So in case you fail to pay, the bondholders can come and sell off that factory. You get it?
Okay, yeah.
Now, in case there's no security, okay, then that's referred to us as a debenture. Okay, it's a bond where there's no security upon which they can go to dispose of the money, to dispose of the asset and repay themselves.
Okay, so in case of liquidity,
in the case of liquidation,
debentures won't be paid.
In the case of liquidation, no, they rank after the bonds.
Okay.
Yes, in the case of liquidation, they rank
bonds
after.
are referenced, right?
Sorry?
Like bonds are paid first before debentures.
Yes, the debentures, yes. Okay, so the bonds, so that all the other terms remain constant, the bonds will be paid before any amount can be paid to the debenture holders. Yes.
Okay.
Okay. Great. Then see you tomorrow. I'll try to follow up with the